Conceptual frameworks and accounting standards play crucial roles in financial reporting by providing structured set of guidelines and principles that help ensure consistency, comparability, transparency, and relevance in financial statements. Key reasons why they are essential in conceptual framework, the basis for accounting standards, guidance for financial reporting, consistency and comparability, relevance and reliability. In accounting standards, the uniformity and consistency, transparency and disclosure, compliance and legal requirements, investors' confidence. Therefore, conceptual frameworks and accounting standards are essential components of financial reporting framework. They provide the necessary guidance, principles, and rules to ensure that financial information is relevant, reliable, comparable, and transparent, ultimately facilitating informed decision-making by users of financial statements. The key components of a conceptual framework in accounting may include number 1, objectives of financial reporting. This is by clearly defining the purpose of financial reporting, such as providing information to investors, creditors, regulators, and other users for making decisions. Number 2, qualitative characteristics of financial information. Identifying the key qualitative attributes that financial information should possess, such as relevance, reliability, comparability, and understandability to be useful for decision making. Number 3, elements of financial statements. This is by defining the basic components of financial statements such as assets, liabilities, equities, income, and expenses. Number 4, recognition and measurement criteria. Establishing criteria for when items should be recognized in financial statements and how they should be measured, ensuring consistency and comparability. Financial reporting refers to the process of producing and communicating financial information about companies' financial performance and position to external and internal stakeholders. Financial reporting typically includes the preparation of financial statements such as the balance sheet, income statement, cash flow statement, and statement of changes in equity. These reports provide a snapshot of a company's financial performance and position and are used by stakeholders such as investors, creditors, and regulators to make informed decisions. In financial reporting, there are standards established by accounting organizations or regulatory bodies to ensure consistency, transparency, and comparability. Some of the key areas covered by accounting standards are number 1, recognition and measurement. Standards related to when and how transactions and events should be recognized in the financial statements, as well as how they should be measured, sample like historical cost and the fair value. Number 2, the presentation and disclosure. These standards on how information should be presented in the financial statements, including the format, the layout, and classification of items, as well as the required disclosures to provide users with relevant information. Number 3, the accounting policies. Standards that require companies to disclose their accounting policies and methods used in preparing the financial statements to promote transparency and consistency. Some accounting standards provide specific rules or guidance for certain industries or type of transactions to address unique complexities and considerations. Number 4, reporting framework. These standards that outline the overall framework and structure for financial reporting, such as the conceptual framework to guide the development of accounting standards and ensure coherence in financial reporting practices. Number 5, the ethics and professional conduct. The standards related to ethical behavior and professional conduct for accountants and financial professionals to uphold integrity and trust in the profession. This, Therefore, the accounting standards are essential for ensuring the reliability, relevance, and credibility of financial information provided by companies, which is crucial to stakeholders in making informed decisions. Compliance with accounting standards is usually required by law or regulations in most jurisdictions to maintain the integrity and transparency of financial reporting.
The conceptual framework defines the elements of financial statements, which are the building blocks of financial reporting. These elements represent the economic resources, obligations, and equity of an entity. The elements are categorized as assets, liabilities, equity, income, and expenses. The key elements of financial statements typically include: number one, assets. Assets are the resources owned by the business that have economic value, such as cash, inventory, equipment, and property. Number two, liabilities. Liabilities are the debts or obligations of the business, including loans, accounts payable, and accrued expenses. Number three, equity. Equity is the residual interest in the assets of the business after deducting liabilities. It represents the owner's claim on the company's assets. Number four, revenue. The revenue is the amount of money earned from the sale of goods or services. Number five, expenses. The cost incurred by the business in generating revenue, including salaries, rent, utilities, and other operating expenses. Number six, profit or loss. The difference between revenues and expenses, indicating whether the business has generated a profit or incurred a loss during a specific period. These elements are presented in financial statements such as the balance sheet, income statement, and cash flow statement, which provide comprehensive overview of a company's financial position and performance. These statements are usually prepared annually to give stakeholders, such as investors, creditors, and management, an overview of the company's financial health. By analyzing these statements, interested parties can assess the company's profitability, liquidity, and overall financial stability.
The main components in financial reporting include income statement, known as profit and loss statement, balance sheet, known also as statement of financial position, statement of cash flows, statement of changes in equity, notes to the financial statement, management discussion and analysis, and auditor's report. These components work together to provide a comprehensive view of a company's financial performance, position, and activities, helping stakeholders assess the company's financial health and make informed decisions. Purpose of using financial reports in business. Financial reports are essential tools used by businesses to communicate their financial performance and position to stakeholders, such as investors, lenders, management, and regulatory authorities. The main purposes of using financial reports in business include decision making, performance evaluation, investor relations, credit worthiness, regulatory compliance, internal control, tax planning, strategic planning, stakeholder communication, and risk management. Financial reports play a crucial role in enabling businesses to track performance, make informed decisions, comply with regulations, communicate with stakeholders, manage risks, and drive sustainable growth. Users of financial reporting. Various stakeholders rely on financial reporting to make informed decisions. Some key users of financial reporting are investors, creditors, management, regulators, employee, suppliers, and customers. Financial reporting serves as a vital communication tool that provides essential information to various stakeholders, enabling them to make informed decisions that impact the relationships with the company. Financial reports are typically prepared by the finance department of a company or organization. The specific roles involved in preparing financial reports may vary depending on the size and complexity of the organization. But some common positions responsible for financial reporting include Chief Financial Officer, the CFO, Controller, financial accountants, external auditors, and financial analysts. A collaborative effort among various members of the finance team, including the CFO, controller, financial accountants, and external auditors, is typically involved in preparing financial reports. This ensures that the reports are accurate, reliable, and in compliance with relevant accounting standards and regulations. Entities using financial reports are an essential tool to communicate their financial performance and position to stakeholders. Here are some of the key business entities that use financial reports: the public traded companies, the private companies, the non-profit organizations, government entities, the financial institutions, the investment funds, and the small businesses.